How's everybody doing? Welcome back to my channel. My name is Frank Bunn, and I have been teaching traders to get consistent trading virtually anything that's chartable since Marie Antoinette here was escorted to the guillotine. Today, we're going to talk about the retail ripoff. And much has changed in the retail game and as far as retail access to the US markets in the last bunch of years. Some things haven't, but most notably has been the free commission. And the free commission, thanks to apps like Robinhood and mobile app access to the markets, enables anyone with a small amount of capital to make trades, enter markets in and out without paying commissions. Now, this may seem like a boon, but we have to look at contract theory. Just like information asymmetry, we got to look at the seen and the unseen. And what we're going to see is, in many cases, it's probably or was probably more advantageous to pay commissions than it is to not. So several things have happened with the advent of zero commission trading. One, the bid-ask spreads have widened significantly. Okay. So the bid-ask spreads have widened significantly. Second thing is we have this insidious thing now called PFOF, payment for order flow. Okay, so what happened then? Well, let's take a look. Back in the day when, you had your brokerage account at E-Trade and, you were buying shares of XYZ and the spread was, 0.10 by, 0.05. Your broker charged you probably $5 or $10 per round trip, and their incentive was to get you the best possible fill. And this, with the advent of more electronic access to the markets, this was called price improvement. Now, the broker then would improve your fills for option stocks or whatever, working the difference between the bid and the ask on your behalf. Now, with zero commissions, the broker no longer has any incentive to do that. Okay, so as a result, spreads have widened simply because now there's this entity of payment for order flow. So, if you thought that the broker was trading against you in the 80s, think about it now. Now what happens is exchanges, which are market makers, broker dealers, will pay brokerages for order flow. Okay, so now the broker does not have any incentive to get you a better fill or even to keep you as a customer. They have incentive to route as much order flow as they can. Now, what's happened here, as we've seen this go on recently, brokers have tried desperately to move to a more service-based. So they'll focus on tools, most of them bullshit that can't be used. They'll focus on what they can provide you, hot lists, investment advice, whatever that is, because they no longer get the commission for those. So now, let's take a look at the effect of this, because it's very, very insidious. So the problem with having the institutions trade against you almost immediately is that it becomes more and more difficult to take smaller losses and assure profits. Because if you think about what happens with the advent of the large bid and ask spread, okay, and also payment for order flow, you're paying more of a bid-ask penalty than you ever had before. Now, what does this mean? That means that on all of your entries, the tendency then is that you're overpaying if you're going long, and on your exits, you're either losing more profit or more margin. All right. So what happens over time is if you look at this on a scale. Okay. So here we have an XY axis, let's say. Okay. So, all right. This is your equity curve, and this is time. Okay. So normally with an equity curve, we look like this. Depending on your volume, though, and the amount of trades that you're actually taking, given that you're losing a lot more with the spreads and the way it is, you're the theoretical equity curve could actually be much higher over time. Why? Because as I teach students to build wealth, what happens is when you get size, and you're talking about routinely entering $100,000 positions or greater, those few pennies here and there add up to thousands and thousands of dollars over time. Theoretically, over long enough, probably hundreds of thousands or greater. Okay, so there's the insidious thing. So it's easy to take a look at this and say, well, I just get in where I get in, I get out where I'm out, and I profited. But you have to look at the insidious aspect of equity loss over time because of the lack of incentive to get you a decent fill. All right, so this is exactly what is going on with retail these days. Well, now, how do you beat that? Well, the one way to do that is to ensure that your entries, you need what's called entry and exit efficiency. And we work on that here in the office all the time. Okay. What's the most efficient? So when we enter, we basically want a breakout and a stop limit, okay, that establishes our price points very, very close to where we get, and a limit order to ensure that we're not overpaying. So we're not even going to try to play the bid-ask game for that. We're going to try to get the best possible stop limit as close to our entry price point as we can, okay, to eliminate that slippage. So that's what we do there. Now, on exits, what do we do? Well, it's more focused on very specific targeting. So, for example, in my short interval models, I'll have a 1% to 2% target. Okay, I used to exit the market in case they don't trade, or in case they would trade around me. It was much more efficient. A lot of times I could get positive slippage. I don't do that anymore. Now I work a strict limit order to ensure that my targets are hit over time. So, for example, if we're going back to this idea of our equity curve, okay, let's just say, like, here's my equity curve. Okay, so in this case, I was hitting 1% targets, for example, or let's say 5 to 10 on a daily, weekly interval. But I'm losing maybe 1/4%, 1/3%, whatever that would be. This would be my real effective, this is my real equity curve, but my effective equity curve would be much higher over time. Okay, so you need to be certain that you're getting that, and you're also controlling, you're controlling that risk. The key to getting around this whole game, though, is knowing how to trade. That is, how to second guess order flow and get price points, low risk entry price points that immediately reject, so that you're not playing the retail game. You're not in there bartering and bickering over price. If you really want to learn how to do this, there's a link below. I teach this to students every day, and I really enjoy the process. You can check out my free training, which will give you a lot of great information on how to really make a go at one of the crookedest games, but also one of the most rewarding financially or otherwise on the planet. Thank you very much for joining me. Have a good day. We'll see you next time.